Hey everyone, it's Jeff Trapp here with the Jeff Trapp podcast and the tax planning pros. And I am so excited that you decided to join me today. This is just one of my favorite times of year. And because we are in the spirit of Thanksgiving and gratitude, I am grateful to all of my listeners who are out there. And, I'm grateful that there is an opportunity to help you all save some money on taxes between now and the end of the year. And because I am so grateful for my listeners, today I do want to open up the floor and answer some questions from our listeners today. Now, these won't be live questions. These are questions that have been submitted to us over the last few months. And I really want to address those things with you all today. And so, this is going to be a great opportunity, a great learning experience, I think, for you as you try to craft your tax plan between now and the end of the year. So I'm going to go ahead and read off these questions. So if my eyes drift away from the camera, that's why. But the first question that we have, is Jeff, what's new in 2025? I know the one big, beautiful bill changed quite a few things, right? So there's some really great incentives in the big, beautiful bill. We have several podcasts on the big, beautiful bill that you can go back and listen to, where I see some really big benefits, right? For business owners, the research and development credits are back. They've been made permanent. And that allows taxpayers that do research and development to go back and amend tax returns, all the way back to 2022. And you have until July 4th, 2026 to do those amendments, get those credits. And that's going to create a lot of tax savings for folks who do research and development for their business. Another huge thing that came out of the big, beautiful bill, right, is the 100% bonus depreciation. So if you're buying depreciable property that's valued at 15 years or less in terms of depreciation, you're going to get 100% write-off. So that could be leasehold improvements. That's huge, right? That could be for vehicles over 6,000 pounds, furniture, fixtures, equipment. And where you can get a really good bang for your buck is if you're a real estate investor, right? You qualify for those real estate investment provisions. You can take advantage of cost segregation to depreciate property quickly. So there's some good things there. And then on the individual side, that $40,000 state and local income tax credit, I'm really excited because that used to be $10,000. That's $40,000 if you're making under 500 grand, married, filing joint, and you're working with a strategist to help you do that, because a lot of our clients make well above $500,000. And so how can we get them down below that level to maximize those deductions? So really neat things in the big, beautiful bill. And the thing that I love about the big, beautiful bill community, it's all rooted in the tax code, and it, benefits you as the taxpayer. So some another question is we get a lot is what is the risk? What is the risk for tax planning? My CPA seems to be very compliance oriented, where they just file my tax returns, but they don't strategize with me. And so, there are two kind of things that we want to talk about when it comes to risk. That we want to talk about investment risk and audit risks. So, we provide our clients with opportunities to invest in certain things to be able to bring down their tax bill. And all of these opportunities, right, are rooted in the tax code. And, we don't know how many pages long it is. Some have estimated 70,000 pages long. And so there's a lot to really unpack there. And that's what we're really done for our clients. So, investment risk is about performance, how the actual project or company does over time, really just depends. But with tax advantaged investments, you typically at least get the tax benefit itself, right? So if you invest in something like real estate, right? If you invest in a commercial property or an Airbnb or something like that, and you do cost segregation on that property, you take the 100% bonus depreciation for that property. Doesn't mean you get to depreciate the whole thing. You're going to create significant tax deductions. And a lot of folks are like, well, Jeff, how can you do that? What is the audit risk on that? Right. But really, when it comes down, it's about documentation and compliance. So every strategy that we use, and that's just one of them, right, is built around specific things in the tax code, right? Because you've got different things in terms of bonus depreciation, Section 179 depreciation. You've got solar credits, oil and gas incentives, and there's a lot of different things. And really, what you want to make sure is that these programs have been well vetted. So we vetted all of these programs. We rely on legal opinions and attorneys and appraisals, and we rely on, other, I guess, CPAs who are heavily embedded in these programs to determine if these are the right things. And really what the IRS expects is they want you to be able to structure these things well and really button things up. You don't want to take advantage of these things loosely. And so that's really where we come in. We want to make a defensible approach for the IRS. And here's the thing, right? We don't recommend anything to our clients that are on the IRS dirty dozen list. Most of the things, when it comes to tax advantage investments, you may not find on the internet, right? You won't find in a basic Google search. And so, these are things that are mostly laid out, right, for certain people. And so one of the questions is like, if these strategies are so good, why doesn't everybody know about them? Why isn't my CPA telling me about this, right? And, that's really the $1 million question. And so first, there's a few things to know about, right? Complexity, the tax code sections that create these various incentives are extremely technical. Most accountants don't want to, learn anything else, right? You come out of school, you get your CPA, EA, whatever your licensing is, you go to work for a public accounting firm, and really what they do is they stick you in and you start preparing tax returns. Well, 90 to 95% of accountants continue with that at some level until the day they retire and they just do tax returns. And really, if you want to learn about these things, you have to have really a growth mindset and go out and learn these things because they're not going to teach you that just in a simple textbook, right? And so you have to have that growth mindset to learn about these various strategies. The second thing, you want is access to these strategies. Many of these programs are private offerings. We have to sign NDAs to review these programs. And a lot of times our clients have to sign NDAs to review these details. Also, right, you have to a lot of times be an accredited investor. Well, an accredited investor is somebody that makes over $250,000 adjusted gross income or has assets over $1 million. And so they may not be available to most taxpayers. That's why, when some of the folks I talk to my friends are like, oh, really? You can do X, Y, and Z and save money on taxes? Yes, you can, but there's certain steps that you must follow. And then, like I said, 90 to 95% of tax or accountants are focused on compliance, not proactive tax planning. And really, we have to coordinate these strategies with various CPAs, attorneys, in some cases, not all cases, licensed investment advisors. And really, there isn't a one size fits all approach. These are designed for, a very, very niche specific people. And at the Tax Planning Pros, we typically work with folks that have a taxable income on the low side of 500,000 and on the high side, $25 million. And so that's where these strategies are geared towards. These strategies aren't hidden. They're available to, everybody that meets the investment requirements or the strategy requirements, but you just need somebody that understands the process and has the expertise. So, everybody's like, Jeff, can you give me a real world example? Like how would this work? Right. So, you know, we had a client last year that was earning $2 million on a W-2, doing phenomenal. So instead of paying all of the tax to the IRS, they reinvested $105,000 into a qualified business acquisition where they were a material participant. They met all of the IRS requirements to be able to run that business for the year. And they had a for profit motive because they're in this business, they're generating income. Well, with the investment in that business, because just like investing in a home, right? You put a down payment down. If you put a down payment of, $105,000 down, you might get a home that's worth $500,000, $600,000. Well, that's exactly what they did. They put a down payment down of $105,000. They got $626,000 worth of a product that they could generate income off of. And their tax bill dropped by $231,000. And they also get income from that investment. So they get cash flow every year. And then, the goal is to eventually they want to sell that investment. So there's going to be a liquidity event, which is taxable, which is great. That's fine. But a great investment to get a tax deduction today, like very much like real estate, and they're going to save $251,000 in taxes in the first year. So when you put all of that together, that's about a 350% return on their investment in 3 to 4 years if that liquidity event happens. So these are just deductions, right? These are structured opportunities. So now we're in November, and by the time this podcast airs, there's not going to be much time left in the year. And so what we're seeing is most of our opportunities are starting to fill up and get fully committed. And most of our opportunities, right, will be done by December 12th, right? So that's really the cutoff for most of these things, but we're seeing some of the best things fill up quickly, but there is still time if you want to get in. But I would recommend, like, hey, you want to sign up with us, you know, before Thanksgiving so you can actually plan, you know, our typical engagement, right, is somebody would come on earlier in the year and we would have the opportunity to really be that, I guess, 31 flavors, right? If you think of ice cream, give you some options in terms of tax planning. Now you're at the point in the season where you don't really have options. You don't have time to do as much due diligence. You have to, rely on us as the experts to guide you. And you're really stuck maybe with one, two, three things in that, you may like those things. You may not like those flavors, right? You may not want chocolate and vanilla. You might want cookies and cream or, you know, chocolate chip or something else, but you might be stuck with chocolate and vanilla when it comes to your tax planning. But when it comes to tax planning, all of our strategies align with different sections of the tax code and they're professionally structured. So there's a lot of opportunity out there, and where the opportunity lies is right, especially as if you're proactive, you're planning ahead. Now, if you procrastinated this year, it's not the end of the world, but you know, there's still time to save now. And if you onboard now, right, then you're going to have a great foundation for 2026 and save even more money. And so that's really the exciting thing. One of my favorite speakers, John Maxwell, and he wrote a ton of books. He said, gets the question like, when's the best time to plant a tree, right? Well, that was 25 years ago. When's the second best time today? And that's the same with your tax strategy. You've been probably missing out for years, months and months this year. So the time to do that is now. And there's some great opportunities to do that. And really, what we want is we want you to have more cash flow. We want you to have more money to invest in what you love to do, right? Like our mission statement is we want to help our clients create a long-term wealth legacy for them and their families. And so what can you utilize that extra money for to create that legacy for yourself? Because I don't think the IRS spends your hard-earned money better than you do. So once again, I hope you all have a wonderful and happy Thanksgiving. So grateful for the listener questions today. There are some great opportunities out there to save money on taxes. And if you know of any taxpayer, I know whether individual, business owner making between 500,000 and $25 million. There's some great opportunities for them to save money on taxes between now and the end of the year. Once again, I'm Jeff Trapp with the Tax Planning Pros and the Jeff Trapp Podcast. And I can't wait to chat with you again in December. Have a great one. Bye bye.